Good morning, everyone. Hi, Ron.
Morning, Kath. How are you?
I'm good. Welcome to the Baby Boomer Investing Show. We got a great show today, you guys.
Another one, another
Yeah,
hit.
today we're talking about the 60-40 stocks bonds is the way too risky for baby boomers.
Yep.
Okay.
So we've said that on just about every show, but we never did a show with this title and just focused on 60/40. And what started me thinking about is every day now I'm getting some article about 60/40. So it's really become a hot topic this year. And some of the articles go, they're defending 60/40. It's worked forever. Don't change it now. It's great. Hang in there. 60/40 is the answer. And but most of the other articles are saying 60/40 is wrong now. And virtually all of those who say that, this is going to surprise everybody. They're selling something.
Yeah, right. Yeah. So honest to God, when I was just going to say, are these financial advisors that love the cookie cutter because they don't have to work? you
Well,
know,
that's
it's just,
we're going to talk about two things. One is why is 60/40 the answer?
yeah.
And yeah, that's part of the answer. And then why it's wrong for baby boomers. And then what baby boomers need to do to not take the risk in the 60/40. But these articles that are saying 60/40 is wrong, they're all picking on the 40%. So the 40% is an allocation to bonds, and they're all saying bonds are way too risky now. That mix is not going to work. What you need to do instead, and complete that sentence with whatever it is they're selling, alternative
Oh,
investings or
oh, yeah,
annuity.
right. Yeah, yeah.
So, so it's become
Isn't
hot.
that sad? Isn't that sad though, Ron, if
Well,
you really
everybody's
think
selling
about it?
something. I mean, this is just the way the world works. We're actually selling something at the end of this, but it's just not much. It's a little.
Yeah.
We're asking for a little bit of help. But let me start with on the next slide, Kath, about why that 60/40 is the answer for a lot of people. On the left hand side here, if you haven't seen a picture like this, you should at least be aware that it's going on in the background. So everyone, consultants, investment managers, everybody is using what is called models. And a typical set of models would look like these five. And the idea here on the lower left is you take low risk, you get low return. So the vertical scale is return, the horizontal scale is risk. Then as you move over to the right and take more risk, you get more expected return. You would not take that risk if you didn't expect to earn more. And you can all read what these are. So they go from conservative to aggressive. And the one in the middle is 60/40. And it's no surprise that sort of, if you can't really figure out if you're right or left, you end up in the middle. So the average allocation for people in IRAs, individual retirement accounts, is 60/40, regardless of your age. 20-year-olds are 60/40, 40-year-olds are 60/40, baby boomers are 60/40. The average allocation is 60/40. And we did an episode on this about the history of investment consulting, and it pretty much explains why that is the answer for everybody. The other thing I just want to reinforce here is you may be told that your portfolio is being custom designed for you, and it may be. It's very rare, but it does happen. But in the vast majority of cases, the manager or the consultant is using a family of models that looks like this. Then on the right-hand side, there's been a big deal in 401k plans. It's called target date funds that we've talked about a lot. And that has grown to $2.5 trillion in just a decade. So it's become very popular. And target date funds are for people who don't know how to make a decision. You're in your 401k plan. You're naive. You don't know a stock from a bond. You don't know IBM from Xerox or any of that stuff. So you do default is what it's called. And that means the employer has to make a decision for you. In that space, which you again talked about, there's an oligopoly. There are three companies that manage more than 70% of that $2.5 trillion. And you can see them there. It's Vanguard, Fidelity, and T. Rowe Price. And what we're showing here are the glide paths. So on the far left is the equity allocation for young people, and it's pretty high, about 90%. And then the quote glide path for a target date fund lowers equity allocation as you get close to retirement. So the target date is your retirement date. All three of the oligopoly members end up at about the same place for people who are about to retire. And it's not quite 60-40, it's 55-35, but it's close enough. And the key thing there for people who are in target date funds is most of that 40% in bonds is in long-term risky bonds. So the target date fund industry at the target date is 90% in risky assets. And that's just wrong. So at the top of this, I just want to reinforce where the assets are today. There's $10 trillion in individual retirement accounts, IRAs. There's another $8 trillion in 401k plans. So most of the $30 trillion is in basically plans where the beneficiary is taking the risk. The other form of retirement are defined benefit plans where the employer basically pays you annuity all the time. And those were really very nice, but they end up being extremely expensive. So most of what's left in defined benefit plans are in government plans, for like the state of California and so on. And then some are in union plans, but the unions are, I think, starting to gradually moving. They're leaving people in the defined benefit plans, but moving over and adding defined contribution 401k plans. So 60-40 has been the pat answer. It's been that for a long time. And on the next slide, we're going to talk about why it's wrong for baby boomers. And I just want to be clear, I'm not saying 60-40 is wrong for everybody. It may be just right for someone younger, but for a baby boomer, we all have a cycle in life where on the top of this graph, the green line is we save through time. And that builds up, and as we're about to retire, it will reach its peak because after that, we start to spend it. We're drawing it down. And the people who think about how to invest during your working life call the transition from working life to retirement the risk zone. And we all have realized that when we take risk, there's a risk of loss. And that happens to change and become much more important during the risk zone because that risk of loss becomes the risk of ruin. If we're unfortunate enough to lose money during that transition, even if the markets recover, we're almost certain to have to reduce our standard of living. So it's you only get to do this once, and you don't want to be cavalier about it.
Yeah, right.
And one of the things you don't want to do we started this whole show because I think many people who are baby boomers don't know what their asset allocation is. Mm-hmm. They really don't. And they're trusting an advisor or somebody else to make that decision for them. And we think if they look, they're going to see that they're 60-40. And they need to, they might embrace it and want to take the risk. We think it's foolish, but that would be their choice. But they at least need to know. And then if they agree with us, we're sort of giving some guidance on what to do to be as safe as they should. So the red line in this graph basically is the amount of risk. So a target date fund sort of follows this kind of pattern. And the idea here is when you have $1 in the bank, not much in savings, your risk doesn't really matter. I mean, if you lose half of it, it's 50 cents. You can make that back in working an hour or two. But as the amount at risk grows, your savings, it's wise to protect those savings. So save and protect is a excellent mantra for retiring with dignity. So when you're in the risk zone, you should be at very low risk. That LAMP is a lifetime asset management plan. Then sort of a breakthrough that's happened just recently, last about 10 years ago. There's been a lot of questions about, so what's sort of a good glide path when you retire? There are a lot of conversations about a glide path when you're working, but how about when you're in retirement? And these researchers have found something sort of counterintuitive, and that is the optimal glide path in retirement is to re-risk again, to put basically more into equity, stocks and real estate and things like that. And the notion there is sort of symmetrical to the left-hand side, where how you're investing when your account balance is low. As the assets deplete, the dollar impact of a loss goes down. So at the end of life, you sort of might finish just about where you started life, with a dollar in the bank. Losing a lot of that isn't going to move the needle much at all. But increasing the risk does have the benefit of hopefully extending the life of the assets. So this is that last part is sort of a revelation. So now I want to reinforce this idea holds regardless of what the economic situation is. If we had a thriving economy, no COVID, no nothing, it still makes sense for baby boomers to be protecting their assets. Number one investment objective should be, don't lose my savings. But this is not an ordinary economic time. So we got a wake-up call in 2008, and I want to remind boomers. So baby boomers were there in 2008. Millennials were not. Well, they were there, but they weren't invested. So on the next slide, Kath. In 2008, the 60-40 mix lost 32%. Stocks lost 50%. Bonds saved the day. They lost only 5%. So the 60-40 combination of that was 32%. On the right-hand side, target date funds, some lost more than 32, some lost less than 32, but the majority of target date funds for people retiring near 2010, they're called 2010 funds, lost a substantial amount. The glide path I'm going to recommend here is called the SMART glide path. It was down 10%. So you could have defended in 2008. Most did not. Tips, by the way, here are Treasury inflation protected securities. And you might recognize that the companies here, you might want to single out Vanguard, Fidelity, and T. Rowe. You can see they sort of cluster together at losing between 30 and 37%. So we had a market crash 13 years ago. We also had one March of last year that was sort of a wake-up call, but it recovered. So the recovery to the crash of last year was the fastest ever. It was just incredible how quickly it came back. So we were down around 30% and came back within 4 months. Got it all back. Today, on the next slide, Kath, we are higher risk today than we were in 2008. Or put another way, if we were having this show right now at the end of 2007, just before the 2008 correction, we would be talking about some exposure. Markets were very high priced. The .com was the big deal. Housing, you didn't need to put anything down to buy a house.
Yeah, right. Yeah, yeah.
It was things were crazy and high risk.
Free houses.
Sure. Yeah. But for almost no interest. So there are definitely things wrong you could talk about, but today there are really, really serious concerns. And I'm just going to highlight them on the next slide. So the concern about 60-40 is certainly legitimate for bonds. Now let's start at the bottom panel here. Bonds today are riskier than they have ever been.
Really?
Yes. And one of the measures of bond risk, and it's a pretty good one, is called duration. And the idea behind duration is you take the number that is duration, It's currently 6. And you multiply the change in interest rates by that number. So if interest rates go up by, say, 10%, which I really think is a possibility, because they're almost zero now, if interest rates go up by 10%, multiply that by the duration of 6, bond prices will go down by 60%, more than half. You can see in 2008, bond duration was at 4, substantially lower. So we are right now literally in the riskiest bond environment that we have ever been. So that, for people who are saying that 40% in bonds, don't do that, it's pretty good advice.
Yeah, sounds like it. Yeah.
It's really risky.
Well, let me ask you this, Ron. And for those of you that don't know, I'm Ron's sister, and I'm the one that
You are?
yes, and I'm the one
Okay.
that is the baby boomer that doesn't really understand a lot of this. So Ron is teaching me through the course of these shows. But what I don't understand is that don't these financial advisors, don't they get updated? Don't they get training on what they really should be selling, or are they just complacent with taking the easy way out?
Again, when our third episode was the history of investment consulting, and everything is wrapped around models. So I think if the consultant today is sort of in tune with the high risk in bonds, they're probably saying something like lower the maturity of your bond holdings. So don't hold 10 or 20-year bonds, hold like 10 or 15-year bonds. One of my friends recently told me, I hope he's on this call, that his advisor is suggesting that he use convertible bonds. So there is some recognition that right now these bonds are very risky. But the 60-40 thing is still there. It's you're going to be 40%, but we're going to pull in the risk a little bit. Convertible bonds, by the way, it's actually a combination. It's a bond, and it's also a call option. You can buy some of the stock if it goes up in value. So it's sort of a hybrid kind of vehicle. So no, I do think advisors are sensitive to the 40% and bonds are really risky. I will say on the other part of the risk, which is stocks, we did a whole article and episode on what I call gaslighting.
Right. Yeah, I remember. Yeah.
And I've been watching these shows, reading these things, and Wall Street doesn't want to scare anybody.
Why?
So,
This is a scary thing.
well, I mean, if just for example, if the boomers really heard our message, enough of them,
Hmm.
the market would definitely crash because
Oh,
they really
okay.
need to get out.
Yeah.
I mean, collectively, I mean, these assets are all over the place. They're not just stocks, but 78 million baby boomers control $50 trillion in assets. Now, a lot of that is real estate and homes and everything else, but a good portion of that is in stocks and bonds. So boomers really, the last boomer out the door is going to
Yeah. Yeah.
not be too well off.
Yeah. And I think the scary thing is that we're trying to tell everyone, and if you were to watch this and you do nothing, then that's not such a good thing either. So we want to make
Yeah,
certain that the show is impactful enough that you're going to heed what Ron is saying and take action. You got to check. You just have to check. You have to find out where are you at right now.
exactly. Yeah, that's
Yeah.
a major message. And I think, again, our show about consultants was very much, you want to trust your consultant. You really do. I mean,
You do,
yeah,
but
yeah.
if they're losing you money and you're at high risk, then what kind of advisor is that?
So our message is trust but verify, and it's not our. I think Ronald Reagan said it, but I think he was quoting somebody else. But he was talking about Russia. So you want to trust your consultant, and
Yeah, trust.
there's
Yeah,
some really good consultants out there, but you want to verify if you're 60-40. At a minimum, you want to have a conversation with your consultant.
yeah,
So coming
and
back,
and have them validate why you're at 60/40.
explain why and why that's going to be okay.
Yeah.
Yeah.
Okay. All right.
So
Just
far
my
it's
two
been. I
cents.
mean, the shock we got in March of last year many people, including me, thought it was just the beginning, that 30% hit was going to be a 60% hit. It was just, going to continue on. But instead, on the top panel, Kath, the market after that March crash has come back 58%, 56%.
Oh, I see that. Yeah.
This is incredible.
Wow.
And if you think about putting 56% return in a 12-month period into perspective, statistically, that's a total outlier. The chances of that are almost zero, but it happened.
Yeah. Yeah.
We're up that much. So the typical average rate of return over a 12-month period is 10%. So that's almost 6 times as much.
Wow.
And what that did is, things were expensive coming into this last year, 2020. And there's this measure that Warren Buffett created, and it's the ratio of the stock value of the stock market to gross domestic product, GDP. And that on average runs around 80%. Coming into last year, it was over 200. Then the correction brought it down to 120. And there again, myself and a lot of other people looked at that 120 and said, great, it's got another 40% to go to get back down to the 80. So we're on our way. But it didn't do that.
Yeah.
And now it's at 220, highest it's ever been.
Wow.
This Buffett measure has never been higher. So Warren Buffett just came out in interviews and stuff, and they're saying, so is the market going to crash? And he goes, nobody knows. I don't know. But I do know the market is really, really expensive. And one of our shows, we had the 15 reasons why this craziness is going on. And so some of them operate more in one environment and some of the others, but millennials, for example, are definitely in there. And there's a lot of them, and they got money, and they've never known a market crash. So buy the dip, or the trend is your friend, the Fed will help you, all that stuff is going on. So this craziness might continue to go on. And then one of the shows we showed sort of what seems to be an obvious bubble, but the bubbles can exist. We showed a pair of designer jeans.
Right. Yeah.
With holes all over them.
Yeah.
For $1,500.
Yeah. Right. Well,
and maybe they're more expensive today. I don't know.
That's funny that you should mention about Warren Buffett. I was watching him the other day on YouTube, and how you watch YouTube and you see them passing by, and all I saw was he was really laughing. And I came back, I listened to him, and he was saying exactly, he was going, nobody knows, and laughing about it. It's like, who knows? It's up for grabs. The market is.
Yeah, since Ron Buffett, one of the things he said probably 2 years ago now, we did quantitative easing in 2008, which meant dumping a lot of money on the economy, and it worked. So we would have had a big recession. It would have been awful. But this thing of printing money seemed to save the day. And then they asked him what he thought about that. And he said, it's an experiment of a magnitude that has never been done before.
True. Yeah.
And nobody knows. So we're going to come to that just after the next slide, but we're going to talk about all this money printing. But just to finish the sequence of the deck, just wanted to show people something. On the next slide.
On the next one, okay.
We have never, ever had a lower interest rate. So our current interest rates are way over on the right-hand side there.
Wow, is that 1.57? Really?
Yeah.
Wow.
And this is the thing. About 6-7 months ago, it was 0.5%. So it's gone up from 0.5% to 1.5%. And the press is all over it. And they go like this. So 1.5% is 3 times 0.5%. So the headline is interest rates triple. My goodness.
Yeah. The media is so sharp, aren't they?
I know.
Yeah. You have to wonder.
So no, the reason that bonds are so risky today is because the interest rates are being manipulated, and it's being manipulated all over the world, not just here in the United States. And there's an acronym for it. It's called Zero Interest Rate Policy, ZIRP, sometimes pronounced ZIRP.
Hmm.
And that has enabled all this money printing and debt to go on because the interest on it is small. So if you're going to borrow money, if you could somehow control and you can borrow the money at almost zero, you do a lot of that.
Yeah, right.
But you and I can't control that. If we go to the bank, they're going to charge us something that is reflecting our credit status. And certainly the U.S. government has a lot of high credit, but there is some limit. So that's all scary, but the real scary part is on the next slide, Kath.
Okay.
And this is huge.
Whoa. The scariest money printing.
It Let me just say the numbers, and we've gone through these on some of the previous shows, but quantitative easing put about $4.5 trillion into the economy. $4.5 trillion. I wanted to put that in perspective, and I was thinking, what can I compare that to? What? I know it's a big number, but what would it compare to? I did a little research, and we paid. It cost the U.S. Government and trade. It cost all of us $4.7 trillion for World War II. So all those years of war, all those tanks, all those people, all that stuff, in today's dollars, cost $4.7 trillion.
Mm.
So $4.5 trillion is a lot of money.
Yeah.
Then we've put another $5.5 trillion on top of that for COVID relief. So you add the 4.5 to the 5.5, we got $9 trillion. Now we're really talking. We got some real money.
Yeah.
Then we're going to spend probably $3 trillion
Infrastructure.
on infrastructure, right? By the 4.5 and 5.5 is 10, isn't it? Yeah.
And where is all this money coming from? I still don't get it. I'm still having such a hard time in understanding that.
Yeah.
I
Well,
know it's, well, let's just print it.
yeah.
But then why don't they do that for the homeless and everybody else?
I mean, yeah, we can spend. We did spend a whole episode on the money
Yeah.
printing, but just you brought it up. It's not literally printed like this guy in the lower picture. The Treasury borrows money, so they issue 10-year bonds or 1-year bonds or whatever, and normally there are plenty of takers for it. And in particular, some foreign countries like China and Japan are big buyers of U.S. government bonds. But, and the U.S. public is a big buyer too. But currently, with all this printing going on, there's basically only one taker, and it's the Federal Reserve. So the Federal Reserve is filling up these vaults. The Treasury is printing money. The Federal Reserve is buying it.
Wow.
I just said printing. I didn't mean to say printing it. It's borrowing money, and the Federal Reserve is buying it. And you just get this idea that, I mean, basically it's being manufactured out of thin air.
Wow, that's so scary, Ron. It really, really is. Jeez.
Yeah. Well, that's what's going on, and the underlying rationale justification has gotten a name. It's called modern monetary theory. And it basically says anyone who owns the printing press, using the analogy of printing money, should use that capability to solve economic problems. That throwing a lot of money on the economy will solve a lot of problems.
Right.
And that was a desperation move in 2008. Japan had been doing that before us. I mean, they started the late 90s. So they sort of were the trailblazers. This theory was there. We had, I mean, things were going to blow up, but we didn't do something. So the reinforcement for doing more of it is that it worked. I mean, here we are, no recession. The stock market had its longest recovery ever, 12 years. It's all good. The folks who thought about this idea warned that there's, believe it or not, there's some limit. So you sort of touched on it, Kath. How much of this can we do?
Yeah.
Well, nobody knows for sure, but the warning signal is we get inflation.
Okay.
And I am going to talk about it. I think we're going to get inflation big time. But the sort of,
It's already bad. You go to the grocery store and
yes, yes.
wow. Oh my gosh. And two bags at $100.
I know we're starting to
Wow.
see it, but it's just the beginning.
Wow.
But again, for I don't know if Congress has read the theory. I don't think they have. They're just wanting to get reelected. Um, if we get inflation, you got to take that money back.
What?
Yeah.
I don't get it. What
Well, do
does
you have
that
any
mean?
do you have any guess about how you take it back?
No.
You tax.
Oh, there you go. Yeah, right. We'll give
You
it to
have
you.
to
Yeah.
raise
Mhm.
taxes, and Biden has already signaled that, and it's already unpopular. But the little bit of that he's doing is not going to be enough. It's not even going to be close.
So then what is the solution? Who knows?
Get some people in Congress who really care and know what they're doing. But I think
Yeah.
what we might see here is hyperinflation, really serious inflation. Part of that is probably going to slow down the economy. And when we get a slow economy, when we have inflation at the same time, we had it before. We had it in the 70s, and it got a name. It was called stagflation.
Okay.
And interest rates in the 70s were in the teens, some as high as 20, because inflation was high. And the economy was sucking, so it's really high to pay that interest. And that would be lucky. I mean, I think if we only get that, that would probably be lucky. So let's go to the next slide because I think, well, since we're doing warnings, 13 trillion has got to move the inflation meter. And when that happens, I think the Fed won't be able to continue to keep interest rates at zero. And they certainly won't be able to do it at the longer term, like the 10-year or 20-year treasuries. Even now, our 10-year bonds are at 1.5%. China's bonds are at 3%. And I think the world's starting to discover that for roughly the same credit quality, China's pretty high credit quality, you can get twice the interest. So just in terms of competition for money, I think you're going to see folks finding higher interest rates with similar quality. And that alone will do it, but inflation will definitely do it. So when you increase interest rates, bond prices for sure fall. And I think some people don't understand the symmetry. When interest rates go up, bond prices fall, and vice versa. When interest rates fall, bond prices go up. So bond prices will definitely go down. Maybe even the 60% we talked about if interest rates increase by 10%. Interest rates also impact stock prices because what investment analysts do is they forecast out the earnings on a stock and then they discount that back at an interest rate. And the justification for current high stock prices is that interest rates are low, so we're discounting it back at a very low rate. So that increases what's called the fair value for the fair price for the stock. When interest rates go up, those values are going to tank. And then fourth but not least, this talk about a debt spiral has been around forever. But right now, the government can just barely afford the interest on the debt. So what will happen first, or should happen first, is other government spending will probably have to be cut back. So defense spending is already being talked about being cut back.
Right.
But for people on this call, boomers, we've already said this. Social Security should be bankrupt soon.
Oh
Medicare will go
gosh.
bankrupt before that. And I don't see any action at all, to try to save it. So that those social welfare programs are going to be in the mix of assets that will probably be used to pay down some of this new debt, new higher rate. So that's a scary scenario. I'm not the only one saying it. There's a publication that's called Peak that's been saying it, and others. So it's not just my opinion. It's certainly a possible scenario.
Well, here I am really scared now. I get scared at stuff like that because it probably won't happen in my lifetime. But
It could have to be a long time. Yeah.
let's say if it did, then seriously, what do people that depend on their Social Security and they have no other investments and it's taken away, where do they go?
Yeah. If it's any consolation, I think it would be political suicide to take away the current benefits.
Okay.
So I mean, I've read some stuff about what would save it and so on, and it's a needs test for sure. So Johnny Carson didn't need Social Security.
Yeah. Yeah. Right. Yeah. That's true. Yeah.
We already extended the normal retirement age from 65 to 67,
Mm-hmm.
and there's good justification for that. People are living longer, so those kinds of things will help. But I mean, Congress really needs to dig in and try to figure out a longer term solution. But my personal belief, and it's just that, is I don't think they can take away your benefit. I think you can count on it.
They can do whatever they want.
Well,
Seriously,
they
it
can.
seems as though they have been.
Yeah. Well, one of the I just actually thought of this. One of the key things in Social Security is a automatic cost of living increase.
Right. Oh yeah, that 1%. Yeah.
Yeah. Well, no, I'm saying when it's 20%, that might be something that they override. But I don't know. We'll see.
Mm-hmm.
So, yeah, I think there's good cause to be concerned. But like you say, it could take a while. Not sure how quickly it's happening, but you see inflation right now, and I think they're not done yet. There's going to be another $3 trillion going in for infrastructure. So here we are.
I know.
So the next slide is I think what we're talking about, Kath. We've put this message out there, and I don't know who's listening, if anybody's listening, but we would suggest you don't wait. And then the next few slides are about what you can do. So this slide is about, it's one of the basics that we covered in our very first episode. But Dr. William F. Sharp won a Nobel Prize for showing that when you want to control risk, you can move down what's called the sufficient frontier. It's the red curve here. And where the star is right now, you start with the world portfolio. You own everything in the world. I mean, you don't literally own it all, but you own it proportionate to what is in the world. And you can move to the right along the curve and be more in equities, or you can move down to the left and go more into bonds. On the red line, Kath.
Oh, sorry.
Yeah. So that's been a traditional thing, but Dr. Sharp won the Nobel for saying, when you want to control risk, you can do better than the efficient frontier by just blending the world market portfolio with cash, basically treasury bills. And that follows that line that's shown there, and it gives you higher return for the same amount of risk. So the moral here is, if you are 60-40 and you want to control risk, your advisor is probably telling you that 40% in bonds need to be safer. You should really be thinking about moving to treasury bills. And that would be under normal situations. But I'm going to take one more slide before I get into even refining this idea about moving to treasury bills. For those of you who are in a target date fund, you should be aware that the typical target date fund is about 90% risky assets now, 55% in equities and 35% risky bonds. By the way, individual retirement accounts are 60, so that's the purple line there. What we said earlier is to control risk, you need to be, if you are in the target date fund, you need to get out, even though you're probably there by default because you couldn't make a decision. But you need to do that. You need to get out. And you need to move to no more than 10% risky assets, which is really, really low. Then the thing that about the normal move to safety being to go to treasury bills might not work, but I think as a first order, moving to treasury bills will probably be fine. But I think you need to be watching this inflation thing, and that's on the next slide. So just to reinforce where we are, we've got 9.7 trillion so far with COVID and quantitative easing, and probably at least another 3 coming in with infrastructure. So just call it 13, and that's a lot of money. So if we get the inflation that we've talked about, we discussed this on 2 episodes ago. On the next slide, Kath, we had Gil Weinrich on our show. He's an award-winning journalist, really smart guy.
Yeah, I liked him a lot.
Yeah, he was great. He was fun. So what we're saying is there's all these potholes. There's COVID and inflation and all this stuff. And on the next slide, that the 60-40 is wrong. We've been recommending. No, just
Oh,
just on
sorry.
this slide. Yeah, thanks, Kath.
Okay, sorry.
So I'm in the upper right corner right now. So we've been saying put at least 70% into safe assets. And under normal circumstances, treasury bills would be safe. But we think not so much if we're going to get inflation. And then before we moved on to the answer for inflation, we talked a little bit about the guidance in the Talmud, which is it's not the Jewish Bible. It's like the Jewish place to go for advice.
Yeah,
And
handbook.
So in the Talmud, it says put a third in property, put a third in business, and put a third in reserve. So that's the fallback if you wanted to sort of redo. But again, that's not 60-40 by any means. Or you can maybe do insurance, which is the middle of the bottom thing. And we spent our last episode on that. The only problem with annuities and other sort of guaranteed things is if we get inflation, the payment that you agreed to is going to be worth less because money's going to be worth less. So we think the answer, or certainly something to consider, is to design a portfolio that would protect against inflation. And on the next slide, what we did was we took the advice of the Talmud and said, what would that look like if we're going to use the Talmud for asset allocation and populate it with inflation protection assets? So the real estate would be U.S. and global. Your house would count, so that's part of your real estate investment. I think if you want to carry that a little bit further, you would look, for example, at farmland. You prefer that over, say, a rental property in Manhattan, because now with COVID, people have learned how they don't need that office space.
That's right. Yeah.
So you need to be careful about what real estate. And then Treasury inflation protected securities. They'd have some short term and some regular term. On our last show, we had John O'Brien, who shared something with us that I didn't know. He said that the government is issuing less and less of these inflation-protected securities, and that says something. To me, it says they see it coming, and don't want to be held to honor the promise to deliver, inflation protection. So that's the other third in tips. And then the last third would be in a variety pack of stuff. So blockchain would basically be Bitcoin, precious metals. I think I'd emphasize that you have a separate sleeve for physical gold. By the way, there's been some concern that if you buy claims to gold, so there are many funds that give you a claim to gold, but they don't actually hold the physical. And the documentation is that the claims to gold far exceed the amount of gold there actually is. So if you're investing in gold in that way, you might find yourself disappointed. The other choice there is to old gold mining companies. Don't own the miners and precious metal companies. Agriculture and commodities. By the way, commodities is sort of an obvious play to protect against CPI measure of inflation, because most of the measure in the consumer price index is commodity prices. So you would do that. Then on the next slide, Kath.
So, Ron, if somebody wanted to collect on their physical gold, if they didn't have physical, what would happen if everybody decided to? They just wouldn't have it, right?
Well, I think the idea with physical gold is going back to like a barter system,
Okay.
and that when we talked about cyber securities, paper money is is a means of exchange, which that works fine, but it's also supposed to be a store of value. If that store of value goes away, so those pieces of paper in your wallet are just that, only pieces of paper, then you've got limited choices. But one of those newer choices now is what's called cryptocurrencies,
The Bitcoins and yeah.
bitcoins, and the other varieties of the same idea. And that's catching on a lot, I think, because people are afraid,
Hmm.
that
Yeah.
we're going to get this inflation. The other place that is definitely a store of value are precious metals and gold. But as a means of exchange, it's complicated. So what you say, Kath, is like, how are you going to spend your gold? What are you going to do with that?
Yeah.
I grant you that it's a little more complicated to spend it, but it is indeed a store of value. So it's got that going for it.
It's actually complicated to spend your cryptocurrency right now too.
Well, yeah, this is opening up. Elon Musk, I think, is now taking bitcoins to buy his cars.
Oh,
So
is he really?
yeah,
Okay.
so you can
Yeah.
at least buy a Tesla with bitcoins. So that's good. So that kind of stuff is opening up. Another related thing is China has been working and I think making a big play now for its digital currency. So that's going on. One of the benefits of Bitcoin and other cyber currencies or cryptocurrencies is that no government controls them. They're,
Right.
they're controlled totally by computer algorithms, which basically means nobody understands them.
Yeah, right. And they know how to get around the algorithms
Well, I
in
don't
many
know who
cases.
does. Yeah, but apparently you're not supposed to be able to do that. But maybe somebody has figured that out. But anyway, so that's one of the benefits of the cryptos. The other thing we've talked about is maybe you're sitting there and you're a baby boomer and you go, this is way too complicated. I don't have a clue. Can somebody else just take over my risk? And the answer is yes. And certainly annuities is one way to do that. There's a bunch of other things that we talked about in the last show. The downside for any of these right now is they will be a deal based on current interest rates and current levels of inflation. And if you do any one of these, what you probably want to do is make sure that you can get out and get into a newer version when inflation happens. So annuities lock you in, but these other things generally you can get out of. By the way, the tontines is really an interesting. I don't know, tontines are too complicated, but look up the word. It's just really intriguing. So bottom line, Kath, on the next slide, we are encouraging our viewers, baby boomers, to think about moving to safety, but not moving in the traditional way, which would be going to treasury bills, but move to safety in a way that protects you from inflation. So it's safety from the stock market, but also safety from bond prices increasing or decreasing, interest rates increasing, and a good chance they're against serious inflation. You could certainly think about handing over the risk to someone else through annuities and so on. That's on the bottom thing here. But don't lock yourself in. If you're going to do it in such a way that you can get out without substantial penalty and get into something more contemporary at inflated prices. Then the pitch comes. We got two pitches on this one today, Kath. Next slide.
Okay. Okay.
So I'm writing a book.
Yay.
Hey, and it's for baby boomers. And we've said this over and over again, but you people who are watching this who really are boomers, you're going to spend most of this decade in the risk zone. And if you're lucky, you'll get through unscathed. But if you're not, the next correction is going to change your life. unless you protect. So it's really that serious. And what I've done here is there's all these chapters, but every chapter has a link at the end to one of our shows.
Great.
So you can read the topics here and read our chapter. And then if you want to watch the video, it's there for you. If not, that's fine too. Or maybe you don't want to read. Maybe you just want to go to a video. That's all there. So I'm looking for a publisher. So if anybody here has publishing contracts and could introduce me, I'd really appreciate it. I should be finishing the book, at least all the chapters, probably by the end of next week. So I have 3 more chapters to write. So it's almost done. And then the last slide, Kath, is just a reminder that we have tools for boomers to take advantage of. We have a self-help with the 8-stage robo. Glide Path Wealth Management, we offer investment consulting to baby boomers. We offer it to other people too, but the emphasis is on conservatism and protecting your savings. Younger people may want to work with us there too, but we wouldn't be so rigid in their protection. And that's basically it. So thank you, everybody, for watching the show.
Well, Ron, what we often say to our viewers is somebody like me who really doesn't have financial advisors and that, but those that do have financial advisors, when you get to a certain age, you become very complacent and laid back and figure, well, nothing can harm me. I can't possibly be, I'm set for life and everything will be there for me. But that's not the case. That's what we're really trying to let people know. If you haven't looked at your portfolio, you haven't looked at where you are, you could lose it all. And then it's like, oops, I should have done something.
Yeah.
So
well, losing it all is a little
action.
extreme, Kath. I don't think we'll lose 100%, but we could lose a lot.
A lot. Yeah.
Yeah.
A lot.
So
and if you don't have anything, well, then you have nothing to lose.
Yeah. So I'll even add to that, Kath, just to reinforce it, that you would look at moving to safety as an opportunity cost because the markets are going up every day. And there's this thing that says, it's gotten an acronym now. It's called FOMO, fear of missing out.
Missing out. Yep.
Yeah. So that's a real thing. It's human nature.
Yeah.
But we're saying forget FOMO.
Yeah.
Yeah. I think FOMO should be FOLO, fear of losing it all.
Yeah. Right. Yeah.
FOLA.
FOLA. Yeah. FOMO FOLA.
Yeah. There you go. So anyway.
So who are we going to have on our next show, Ron?
Well, we're going to have a guest who wrote a really interesting book. It's called Retirement Heaven or Hell.
Sounds great.
Yeah, he's a very nice fellow. And the last chapter in the book is happiness. And money helps, but it's mostly in your mind. So this book actually, I'll summarize it. There's a lot more to it than what I'm going to say, but some people are loving retirement by doing nothing. Watching TV, going to the movies, playing golf. They love it. And that's their heaven. That same routine for other people is hell.
Right. Yeah.
So it's in your mind.
And, something.
Yeah. You want to be productive. You have all these great things you want to do. One of our friends pointed out to me the other day that in the old days, where your work probably did not involve your mind, it was physical. You were tilling the fields or fixing cars or doing something like that. Physically, you just could not do that anymore.
Right. I have
so the only choice was to do nothing.
Yeah.
But for those of us who are fortunate enough to work with our minds, I think it's that's our heaven.
Yeah. Yeah. Well, and if you think about it now, look at the way the world is going. Everything is remote. Mm-hmm. Like you pointed out, no more office buildings, no more office space. And if they can convert physical work into somehow making it digitized, they're going to do it.
Yeah, it's just happening. And so the book is really fascinating. It is almost a companion book to we had Larry Siegel on the show.
Oh yeah, right. Yeah.
Then his book was Richer, Greener, Happier, or something like that. And it was basically we should be grateful that we were born now, Because, for
Yeah.
example, if you were born at the 1900s, life was really hard.
Yeah. Could you imagine millennials without a phone?
Yeah, I know. Yeah,
You and I grew up without a phone, Rhonda.
I know. All this stuff that we had to suffer through.
Yeah,
Yeah,
yeah, exactly.
yeah. So
Well, okay.
his point is it's getting better, and
Yeah.
again, the millennials, the youngsters, people are being born today have really great stuff to look forward to.
Yeah, and if they really realized how fantastic technology is for them and
Yeah,
all the wonderful things that they can do when you think about it, that you can see somebody from across the world in an instant
for free.
for free. Yeah. Oh my gosh.
I know.
Let's be grateful, huh?
Yeah, very much so. Yeah.
Yeah.
So the last chapter in the book and our next episode is going to be about being happy.
Okay. Yay.
Yeah,
Okay.
yay.
Okay, good. All
Thanks,
right,
Ken.
great show. Thanks,
Thanks, everybody.
everyone. Bye.
Bye.